Well, good morning. I'm Graffy.
And I'm Hayley, McCollum.
We're both members of the Marquette research team. So for the second flash talk today, we're going to be talking about private markets, opportunities across the capital structure. And on the agenda, what we mean by that is, so top of the capital structure ideas, private credit. We're going to be discussing cycle performance, the effects rising rates have had on the asset class, as well as market convergence the past year. And then bottom of the capital structure, we're going to be talking about private equity, the current market environment, the denominator effect, and the importance of vintage year diversification. And with that, back to you, Hayley.
Thanks, Brett. So first, I'm going to touch on private equity performance. Long-term private equity performance continues to be strong. Median performance consistently has outperformed the Russell 3000 public market equivalent, or PME. Now, the PME is a way to measure how well an investment in a private company or fund has performed relative to the same amount of capital invested in the public markets. Basically, it's our way to assess whether the returns generated by private equity justify the risks and illiquidity associated with the asset class. Though we've seen a resurgence in public market performance this year, we all know that in 2022, public market performance drew down significantly. Looking back at historical downturns in the market, it can help us draw two conclusions about future performance. First, the US buyout trough was less severe than the public markets trough in both the global financial crisis and the dot-com crisis. And second, it took 1.5 to 2 years quicker for performance to recover in both of these situations. Now, what does this mean for investors? Going into the year, this caused investors to be over-allocated to private equity because of the denominator effect. Now, the denominator effect can be shown on the chart to the left. When public markets were down about 19% and fixed income was down 13%, private equity remained relatively flat. So if you took your private equity value over total portfolio value, this would make it seem like investors were over-allocated to private equity in the short term. The chart on the right summarizes how investors are reacting to the denominator effect. 80% of investors are still maintaining or increasing their allocations to private equity. 20% are decreasing, and this is up from 6% last year. So we are encouraging clients to stick with the 80%. The effects of the denominator effect are only temporary, and I'm going to touch on this in a few slides, but good performance typically follows a pullback in the market. Now I'm going to discuss the current market and some metrics that we're looking out for. We're seeing a decline in deal activity, and this is mainly due to an increase in interest rates. High rates have made it challenging to finance deals, and private equity firms are waiting for credit conditions to improve. Deal count, on the other hand, has held up. So this means that the deals getting done are typically smaller in size and easier to finance compared to a large mega buyout deal. Looking into deployment further, add-ons as a percent of deal activity continues to increase. Now, an add-on or an add-on acquisition is an investment by a private equity firm when they buy a related or complementary company with the purpose of taking that new company and integrating it into an existing portfolio company. So these deals are typically smaller in size and scale and easier to finance. Now, only the highest quality deals are transacting. Others are waiting for better credit conditions, and this could be the reason that we saw valuations actually increase in 2022. Now, going into the Q4 and Q1 of next year, we're expecting valuations to come down, and we're already seeing that with the 2023 numbers. So since valuations are on the decline, we think it's potentially a good time to enter in the private equity market. Another reason why investors are overweight to private equity is the lack of exits, and that leads to the lack of distributions to your portfolios. So similarly to a deployment, this is due to credit conditions and a slow IPO market. Private equity firms are holding on to assets for longer, and this is causing a decline in deal activity. One of the common paths of exit is through the IPO market. Exits through public listing remain relatively quiet, although we are seeing developments that suggest a long-awaited recovery for the IPO market is happening soon. Kava IPO'd in June, Instacart is IPOing soon, and there's an estimate of 800 unicorns in the United States that will eventually, most of them will have to go public. Also, investment bankers are saying that they're gearing up for a busy Q4 and Q1 of next year. So the IPO market is something that we're keeping a close eye on because a pickup in IPOs will ultimately result in an increased exits and distributions for your portfolios. Now, since investors are over-allocated to private equity, they're utilizing the secondary market to sell exposures. So what was once thought of as a place to sell tail-end exposures is now a place where high-quality assets are trading at significant discounts. So we believe that there is attractive opportunities to invest in the secondary market to get exposure to these high-quality assets trading at the discounts. Now, it is impossible to time the market, but you can see on this slide that strong performance typically follows a pullback in the market. We are recommending consistent deployment and make sure investors can capture these top-performing vintage years. Although it may feel tough to continue to allocate when the denominator effect is significant and distributions are down, when the market turns, those pressures will ease. There are encouraging signs that the market is going to pick up with the increase in IPO activity that will ultimately lead to exits and distributions. Now we're going to move up the capital structure to private credit. So Brett, over to you.
Thanks, Hayley. So top of the capital structure, top of mind, private credit. When we were here this time last year, we were talking about really the growth of the private credit market the past 10 years and its delineation against the liquid credit market that focuses on lending to really the 16,000 largest businesses in the US today relative to, once again, private credit that focuses on lending to the 5 to 6 million small businesses throughout the US. In those 12 months since we last met, those markets have continued to converge, really as we saw 3 of the largest bank failures in US history that called into question the bank's ability to underwrite and hold debt on their balance sheet. So borrowers, in particular private equity sponsors, have continued to go the route of private credit and direct lending for their financing needs. And looking at the trends that have driven this market, so there's a number of trends that have been very apparent the past 10 years. Bank retrenchment, as we mentioned, private equity dry powder. There's $1 trillion of private equity dry powder in the market today, and about 50 and 60% of that is going to be fueled by private credit or just financing in general. In addition to that, there's been a number of trends that have emerged the past year that have continued to drive that growth in the market. One of them is continued to be rising interest rates and then just a challenging capital markets environment. So if you're a borrower, most likely a private equity manager looking to finance your business or an acquisition, you have the choice of going to a bank or going to a direct lender. More times than not in this market, you continue to go to a direct lender because the speed and certainty they provide in giving you financing, which can be the difference between winning and losing a deal. Well, this has been great for borrowers and lenders. It's also been a great market for investors. As they've continued to earn excess return in the asset class, they've seen a muted default profile in the asset class overall. And finally, it's been a hedge against rising interest rates and inflation really the past year and a half. So you can see on the chart on the right, that's a profile. So you're going to see that private credit continues to outwin or outpace syndicated in financing new LBO transactions in the market. That's been occurring for some time now. In looking at coverage ratios, so a private credit manager jokes me last week that coverage ratios, no one in the analyst class knew what exactly those were until the past year. And what we mean by that is as base rates have continued to rise, which is LIBOR and so forth, and they've risen about 500 basis points over the past year, this has been great for investors because, once again, these loans reset on a quarterly basis and it's been a hedge against inflation. So now all-in yields are north of about 10 to 11%. That being said, it's come at the detriment or liquidity profile of the underlying business. So interest coverage ratio looks at a company's ability to pay its interest expense from its operating income, and then fixed charge coverage ratio looks at a company's ability to pay its fixed charges like lease and principal repayments. And these two ratios really give a clear-eyed view of a company's ability to meet their financial commitments. Luckily, over the past year or so, the coverage ratios have stayed above that 1x metric, meaning that companies, even though interest expenses have really doubled the past year, they've been able to meet that burden by passing on price increases to customers, et cetera. That being said, investors would be wise to continue to watch these ratios because a higher for longer rate environment will continue to eat away or deteriorate at a company's overall liquidity. In talking about private credit defaults, and you've probably read some headlines that continue to go up across the market, and that's come to be expected just given how high interest rates and how quickly interest rates have risen over the past 18 months. But thinking about that relative to high yield bonds and leveraged loans that have a historical average of 3.5% and 2.7% historically. In addition to that, there was a lot of criticisms with the market in 2020 and 2021 that an overly accommodative fiscal and monetary policy kept bankruptcies and defaults at artificial lows. So what we're seeing today is more akin or more attuned to a healthy market environment. There's also an underwriting rule of thumb when it comes to private credit that says a larger middle market company is safer or more risk averse than a lower middle market company. If you look at the 4 quarters of data, that rings true. As companies that have over $50 million or more of EBITDA are defaulting about 25% less than companies less than $25 million of EBITDA. So this begs the question, if interest rates stay high, we continue to see more defaults, what happens to investor capital in really the worst case scenario? So looking at recovery rates here, and this is looking at middle market versus large firms. So middle market here is defined as about companies of $40 to $70 million of EBITDA. And large firms, once again, those are those 16,000 largest businesses in the US that most likely access the bank markets. And we're looking at total debt and then first lien debt. But on average, middle market firms tend to recover about 15% more compared to their larger counterparts. And that's driven by a variety of reasons, but really the main reason is at the company level, middle market firms just have less debt as a measure of multiples of EBITDA and then total loan to value. In addition to that, these middle market firms have less complex, less convoluted capital structures, so you have a much simpler recovery process to get your capital back. You're not finding capital or intellectual property in separate entities, which ends up leading to better outcomes for investors. And looking at how this is played out in total returns relative to fixed income. So as you look at this, you can see that in the 4 of the past 7 years, private credit was the top performer. It was the top 2 in really 6 of the past 7 years. That being said, and I can't stress this enough, this is not simply a story about returns, but it's a story about diversification. The diversification benefits of adding the asset class to a broader portfolio. And as we highlighted earlier, there continues to be strong structural tailwinds that will drive the asset class into the future and allow investors to harvest the yield premium and structure premium for the foreseeable future. And with that, I'll pass back to you, Hayley.
Thanks, Fred. If I can leave you with one takeaway for private equity, it would be to stick to your commitment models, avoid timing the market because then you're at risk of missing out on top performing vintage years. And for credit, there's clearly a large opportunity set with market share growing and the diversification benefits that the asset class provides. Now that concludes our presentation on private equity and private credit. Now I'm going to turn it over to Greg Leonberger for the next section.